I think everybody actually wants a weaker dollar. Scott Bessent's talked about it. The Chinese desperately need it so they don't have to devalue the yuan against the dollar. As you've said, they don't want to do that. The Japanese would probably quite like it. The Europeans would like it. The Canadians, the Aussies. I mean, everybody wants a weaker dollar, and the US wants one. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt. I feel like there's a game to be played here, and the outcome is the Chinese can stimulate, which was 2017 cycle was no US liquidity, it was all China.
Founder and CEO Raoul has long emphasized the deep connection between central bank liquidity and financial market. He argues that liquidity, not traditional indicators like GDP growth or corporate earnings, is the primary driver of asset prices, economic cycles, and market direction. When central banks inject liquidity through money printing, low interest rates, or fiscal stimulus, asset prices typically rise, whereas tightening measures lead to market declines. Powell believes financial markets react to liquidity shifts before economic data catches up, as seen in 2020 when stocks and crypto surged despite a global recession. Central banks, particularly the Federal Reserve, the European Central Bank, and the People's Bank of China, play a crucial role in controlling liquidity through interest rate policies, credit availability, and balance sheet expansions. China, in particular, has a major impact on global liquidity, as its monetary policies influence commodity demand, emerging markets, and risk assets worldwide. Previous stimulus periods, such as from 2015 to 2017, led to broad market rallies, reinforcing Powell's view that liquidity conditions override economic fundamentals. Powell now believes we are on the verge of another 2017-style moment, with China expected to flood the global economy with liquidity. He sees this as the trigger for the next phase of the banana zone, where Bitcoin and crypto prices could skyrocket. He recently shared these insights in an interview with Michael Howell, CEO of Cross-Border Capital. Have you ever wondered who the crypto advisor must be for the biggest names in the online business space, such as Aman Godzi, Andrew Tate, and Luke Belmar? Well, there's one crypto investor who was the consultant for all of them, and he actually shares the systems he gave these influencers to make them millions on his YouTube channel for free, growing an 8 million portfolio by the age of 25. Daniel McAvoy is one of the best crypto investors you'll find online, specializing in long-term investments and meme coin investing. His YouTube channel is packed with incredibly valuable videos that will help you make life-changing wealth from crypto. Start watching one of the greats today, link in the description of this video.
Okay, well, I think we're, as far as I can see, the liquidity cycle is still expanding. I think the issue that we've really got is how much further can it keep going up, because there are certain clear challenges. And I think the two challenges that really sort of concern me, I suppose, number one is the US. And that really comes back to, I think, two particular dimensions. I mean, one is what the Federal Reserve has been doing, which is this sort of what I've termed sort of secretive or not QE stimulus. And that's kind of fading. And they're going to have to go more explicitly to a sort of a formal QE, although I note that Canada also has done that, but it refused to call it QE. So they said they're restarting balance sheet expansion, but it's, of course, not QE. Of course, they would say that, wouldn't they? And the other issue then for the US is the Treasury, where Janet's been doing this sort of very clever funding trick by funding at the short end, where, you know, you kind of look at the math of that, and it's basically meant that the Treasury has managed to stick in the equivalent in liquidity terms of about $6 trillion of additional stimulus by changing that funding dynamic. Now, that's a huge amount, and that's clearly running off fast, particularly if Scott Bessent is intent on moving back to coupon issuance. So I think you've got those two questions, which are really pertinent ones, and they'll really hinge on what the new administration sort of thinks and says. The other issue, which is maybe gives us near-term concern but long-term salvation, is China, where China is currently seeing extreme debt deflation, where the PBOC has taken a whopping amount of liquidity out of the markets in the last 4 to 6 weeks, trying to hold the yuan up against the rising dollar, and they badly need to monetize big time. Well, I would put the figure of sort of 30% monetization. So China's got to print money big time. America needs to do that, not to the same extent. So we're in a long-term monetary inflation, there's no question, but I'm just pausing because I think there may be a little bit of an air pocket now.
Okay, lots to pick apart from there. So the first thing I'm thinking is obviously breaking down liquidity, the reverse repo is almost drained now, and that'll be drained soonish, which probably suggests an end of QT, because you can see bond market liquidity is not great. And you can see that around the world. There's just not enough liquidity in the system. The gilts market's been a mess, stuff like that. So it feels that they're going to have to end QT as soon as the reverse repo drops. Yellen's made it pretty clear that, even though it's Scott's job now, she's going to have to draw down the TGA until they agree something on the debt ceiling. So that, I guess, is a net liquidity injection that's coming from that. How do you measure this shorter-term funding dynamic? And what does that show up as stimulus? Because that's not something that most people are capturing. I read your stuff, and I know you've been talking about it a lot, and it makes sense. But does it get captured elsewhere? Or do you have to just look at bill issuance in its own right and add that to liquidity measures?
You mean you're talking about the funding, how she's changed funding?
That's right, the very short-term debt.
Well, what I've done, there's actually a slide in a pack I sent you, which is actually slide 25, which you can slide into the talk. But basically what that shows is my estimates of what I call not QE, which is what Jay Powell does, and which is the TGA and things like the rundown of the reverse repos. And you've also got on top of that the other bit that I've called not yield curve control, which is unconventional funding. And that is something like about together, they're adding something like about 6 trillion to stimulus. Now, the way that I've done that is to look at a concept called dollar duration and to look at how dollar duration has changed and put that in liquidity equivalent terms. So that's how I estimate it. And that's really against a normal funding benchmark. The skew has been quite noticeable because as you understand, Treasury bill finance has gone up hugely. Bills have been a large proportion of what's funded the deficit in the last 12 months. And on top of that, Janet's skewed the issuance calendar away from long-dated coupons towards shorter-dated ones. And she's taken about a year and a quarter on average out of the average, Treasury auction.
Does that change the debt refi cycle? Or does this just get mopped up in this kind of final year of the debt refi cycle, the 4-year cycle? Or have they restructured it where we're going to end up with, as opposed to a 4-year average cycle, we end up with a 2.5-year cycle?
Well, that could be the case, couldn't it? It could be short cycles are shortened, and they're going to have to, they're going to have to start pushing a lot more liquidity back more immediately. That may be the issue. We know that Scott Bessent's got to fund 30% of the deficit 30% of the outstanding debt this year.
Yeah, and so even if he moves out further duration, the market won't take it without liquidity. Whether it's some form of QE. I think you're rightly suggesting nobody wants to use the word QE anymore because it's a dirty word. So they just find any other way of hiding it.
Yeah, exactly. And I think this is the reality, because if they don't add liquidity, who's going to buy this debt, this coupon debt? And we know the structure of the Treasury market is itself quite fragile because foreigners are not really buying American debt anymore in the size they were. A lot of it's coming down to hedge funds. Those hedge funds, as you will remember, they're fairly fickle, or certainly short term. They want to earn a profit. And as the yield curve is steepening, the cost of hedging is going up the whole time. So often, as you will recall, you see breaks in markets where suddenly people just bail out. And that's the problem the Treasury market could face, a spike up in yields. We're doing pretty well at the moment, aren't we? Yields have moved up quite smartly anyway.
Central banks, particularly the Federal Reserve, are engaging in liquidity-boosting operations that, while not officially labeled as quantitative easing, function in a similar way. Traditional QE involves central banks purchasing long-term securities to inject liquidity into the financial system, lower interest rates, and stimulate economic activity. However, Michael Howell points out that central banks are implementing measures with comparable effects on market liquidity, even if they are not formally classified as QE. These actions include various lending facilities, adjustments in government cash management, and other monetary tools designed to maintain sufficient liquidity. Howell suggests that when all sources of liquidity, whether from official QE programs, lending facilities, or other monetary interventions, are considered together, it becomes clear that central banks are continuously shaping financial markets. This steady infusion of liquidity contributes to asset price inflation, fueling rising stock markets and other financial assets, even if the broader economy does not experience proportional growth. This perspective aligns with Raoul Pal's everything code thesis and his belief that central banks will continue supporting their economies to prevent significant downturns. According to Pal, these ongoing liquidity injections will play a crucial role in sustaining financial markets and driving asset prices higher.
My view on this, I'd like to test the hypothesis, is I think everybody actually wants a weaker dollar. Scott Bessent's talked about it. The Chinese desperately need it so they don't have to devalue the yuan against the dollar, as you've said. They don't want to do that. The Japanese would probably quite like it. The Europeans would like it. The Canadians, the Aussies, I mean, everybody wants a weaker dollar, and the US wants one. But it's fantastic negotiating policy because it's the most powerful throat grip you can possibly have. And so it feels that you get China to play ball in whatever mechanism you've got. And in exchange, you add dollar liquidity into the global system and allow the dollar to weaken. Whether it's, I think the TJ is part of it, but my guess is whether it's swap lines elsewhere, whatever, just to get it into the euro-dollar banking system. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt as stimulus. It needs to do that, but it can't do it without losing control of the yuan for the time being. So if the US will give them cover, kind of what happened last time Trump came in 2017. Right. So I feel like there's a game to be played here, and the outcome is the Chinese can stimulate, which was 2017 cycle was no US liquidity. It was all China.
Yeah, I think that's exactly right. And that was also, in a different guise, what happened in the Plaza Accord in 1995. And that was a very similar deal where the US eased initially, got the dollar down, and then everybody else joined in on the side pumping liquidity. And that sort of led up to the 87 crash ultimately, or the Louvre Accord and the 87 crash. But that was the path. So I think that I've got a lot of sympathy with that. I think that's right. I think the dollar is key. I mean, I agree with you. I think that they need a strong dollar now because it's a great negotiating tool. A longer term, I don't know, but I would suspect they would prefer a firmer dollar than a very weak dollar. But the rest of the world desperately needs a weaker dollar because they're being strangled at the moment. The dollar wrecking ball is definitely swinging.
Popular anonymous Bitcoin analyst Plan B recently surprised the crypto community by announcing that he had moved all his Bitcoin holdings into Spot Bitcoin exchange-traded fund. In his disclosure post, he acknowledged the well-known saying, "Not your keys, not your coins," but explained that managing Bitcoin through ETFs, like equities and bonds, is simply more convenient for him. He also admitted that not having to deal with private keys gives him peace of mind, adding, "I guess I am not a maxi anymore." This move triggered strong reactions from Bitcoin maximalists, with some mocking him by suggesting he change his name to Plan ETF. In response, Plan B defended his decision, arguing that ETFs are a natural step in Bitcoin adoption and questioning whether buying MicroStrategy stock instead of an ETF would be viewed any differently. Despite his reasoning, many Bitcoin purists oppose ETFs because they believe these products contradict Bitcoin's core principles of decentralization, self-sovereignty, and financial independence. One of their main concerns is that ETFs require Bitcoin to be held by centralized custodians, meaning investors must trust third parties rather than maintaining direct control over their private keys. This goes against the fundamental ethos of Bitcoin as a permissionless and censorship-resistant currency. Another major worry is the increasing influence of Wall Street firms like BlackRock and Fidelity, which some fear could lead to market manipulation, similar to what has happened with gold ETF. There is also concern that the growing institutionalization of Bitcoin could allow governments to pressure centralized entities into enforcing regulatory measures that restrict users' financial freedom. Critics argue that ETFs discourage real Bitcoin adoption by making it too easy for investors to gain exposure without actually using or understanding how to store Bitcoin. Instead of learning about wallets, private keys, and self-custody, people might simply buy ETF shares, keeping them reliant on traditional financial intermediaries. This, in their view, transforms Bitcoin from a revolutionary peer-to-peer cash system into just another tradable asset. What do you think? Is Plan B's move justified, or does it undermine Bitcoin's true purpose? Let us know your thoughts in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.